The global economy is heavily influenced by the fluctuations in oil prices, and one of the most significant drivers of these changes is war. Wars, especially in regions rich in oil, disrupt supply chains, increase uncertainty, and lead to price volatility. This video explores the relationship between war and oil prices, examining historical examples and using data to illustrate patterns of price fluctuations. Oil is a primary energy source, integral to transportation, manufacturing, and national security. Oil prices are influenced by supply and demand, geopolitical events, production costs, and the policies of major oil-producing nations. Wars disrupt production and transportation, constraining supply and driving prices higher. Conversely, post-war recovery can stabilize prices. The 1973 Yom Kippur War Arab-Israeli conflict led to the OPEC oil embargo. Oil prices quadrupled from $3 to $12 per barrel, triggered inflation, economic stagnation, stagflation, and an energy crisis in the West. The Iran-Iraq War, 1980 to 1988, two major oil producers were embroiled in prolonged conflict. Initial price spike due to reduced production, followed by stabilization as other producers increased output. The Gulf War, 1990 to 1991, Iraq invaded Kuwait, disrupting one of the world's largest oil suppliers. Oil prices doubled from 21 to 41 per barrel in a few months. Prices fell sharply after coalition forces secured Kuwait and restored production. The Iraq War, 2003. U.S.-led invasion of Iraq, a major OPEC producer. Long-term instability in Iraq's oil production caused prices to trend upward from $30 to over $70 per barrel by 2006. The Syrian civil war and ISIS, 2011-present civil war, disrupted regional stability. ISIS targeted oil fields in Syria and Iraq. Initially pushed prices up, but U.S. shale production and OPEC strategies counteracted the effects. Mechanisms linking war and oil prices. Wars damage infrastructure, reduce output, and create shipping bottlenecks. Example: tanker attacks in the Strait of Hormuz during the Iran-U.S. tensions. Fear of further escalation leads to speculative trading, pushing prices higher. Example: 2022. Russian invasion of Ukraine caused oil prices to surge above $120 per barrel due to fears of disrupted Russian exports. Nations release oil reserves to stabilize prices during crises. Example: the U.S. Strategic Petroleum Reserve was tapped during the Gulf War. Russia-Ukraine conflict, 2022-present. Major oil and gas producer Russia faced sanctions. Crude oil exceeded $100 per barrel, with European energy markets particularly strained. Chart comparing pre-war and post-war oil prices in 2022. OPEC's role. OPEC's decisions to cut or increase production influence war-affected prices. Example: Saudi Arabia's stabilization efforts post-Iraq war. Consequences of war-induced oil price changes. Inflation, increased transportation costs, and reduced economic growth. Example: the 1973 oil crisis caused global recessions. High oil prices spur investment in alternative energy. Example: post-2003 Iraq War saw a surge in renewable energy research. Fuel price hikes lead to protests and political instability. Example: 2019 protests in France, Yellow Vest movement, partly fueled by rising fuel costs. Conclusion: the relationship between war and oil prices is complex, driven by supply disruptions, geopolitical risks, and market psychology. Historical patterns reveal a consistent trend of price spikes during conflicts, followed by stabilization in peaceful periods. Understanding these dynamics is critical for policymakers, businesses, and consumers to mitigate economic impacts and navigate the challenges of a volatile energy market.